going to dive a little bit deeper into analyzing a mobile home park deal. So previously we looked at what a mobile home park was. So this is an example of a mobile home park. It's a big piece of land with all these different manufactured homes on the land. And the homes were built in a factory like this, and they were transported to the land, filling up your park. So when you invest in mobile home parks, you are looking to buy this entire thing with all these units on there, all producing income for you. So let's take a look. We also talked about the different types of housing units. We talked about tenant-owned homes, and this is when the tenants actually own their own home in your mobile home park, as opposed to park-owned homes. And park-owned homes are when you own the unit in the mobile home in your park and you're actually renting it out to people. So this works essentially the same as, say, an apartment. So in our simple analysis, we're only going to be dealing with tenant-owned homes right now. We're just going to be talking about lot rents. And later on, when we do a more full analysis, I'll get into more detail as to why the land portion of the deal and the mobile home or park-owned home portion of the deal needs to be separated out. In this analyzer here, you can see I actually have two different cash flow statements here to analyze the deal. So let's start by just reviewing what it is that we're actually doing whenever we invest. Whenever we invest, we are just buying future cash flows. That's all we're doing. We're just paying today for future cash flows. And the future cash flows may come in the form of monthly rents. For example, you may buy an apartment building for $1 million, and every month you get back $2,000 or $3,000, $4,000, $5,000 in cash flow from that $1 million purchase. The cash flows may come at the end of your investment. For example, you may be flipping a house. So you pay $1 million for a house today, and in 6 months you flip it and you sell it for $2 million minus all your expenses. What's your profit left over at the end? That's also another form of cash flow that you can purchase. With the mobile home park, hopefully you're getting a combination of both. You're getting the monthly income through people paying rent, and your income is exceeding your expenses. So there's actually cash flow. There's money that you're profiting from. And you're also getting cash flow at the end when you sell the mobile home park, because you've added value to it, it's gone up in value, and you're also able to sell it for more than you paid for it, and you're also going to get some profit from that as well. So that's a really fundamental concept to remember whenever things start to get confusing or you're just presented with so much data that you lose focus. Just keep in mind, it's very simple. You're just buying future cash flows. So at the end of the day, your question is, how much should I be paying for those future cash flows? So if you're trying to determine how much you should be paying for those future cash flows, well, number one, you have to find out what those future cash flows actually look like. So when you're doing a full analysis of your mobile home park, you have to look at the entire life cycle. So this is a sheet that looks at the entire life cycle of the mobile home park. It has from year 1 all the way out to year 11, and this includes a sale at the end. That is the proper way to really analyze an investment. Remember, you're buying all those cash flows. You're not just buying the cash flows that come every month, or every year. You're buying the entire thing. You're buying the cash flows that come when you sell. So you have to look at the entire life cycle of your investment, and you have to know what your exit looks like. If you don't know what your exit looks like, then it's probably not something you should be investing in. You really have to know. You have to be able to predict or at least guess at what the exit price of your investment will be. In today's video, we're not going to look at the entire life cycle of the investment. We'll do that later when we actually go through this sheet together. In today's video, we're just going to be looking at how to do an estimate of pricing. And we do an estimate of pricing by applying a cap rate. So a cap rate, the formula for a cap rate is taking your NOI, your net operating income or profit, and this is done on an annualized basis. You get the NOI, you divide it by the purchase price, then you get the cap rate. So the cap rate is just your annual NOI divided by the purchase price, and that is how you derive your cap rate. So in order to do that, you're going to need to know two pieces of information. You're going to need to know NOI, and you're going to need to know what the purchase price is. So if you have a listed deal, this is a deal where the seller has contacted a broker to help them sell the deal. Typically, those deals are going to have a purchase price. Typically, those deals will tell you what the NOI is, and And then you can easily figure out what the cap rate is. Of course, knowing the cap rate is somewhat meaningless if you don't know what the cap rate should be. And it's kind of like if I tell you the price of the car is $10,000, but you don't know what type of car it is, or you don't know what other cars are selling for, then it doesn't really help you all that much. So in order for the cap rate to be useful, you're going to have to do your homework. You're going to have to look at other investments in that area, other mobile home park investments, and see what they sold for and try to figure out what the cap rate is. You can ask different brokers, but that's one source that you can look at for cap rate information. There are reports that are put out specifically for the mobile home park. Datacomp puts out what's called JLT reports, and in the JLT reports, they talk about different markets and what cap rates have been in different markets. You can look online. Certain states have and counties will have the sales history for different mobile home parks, and you won't get an exact cap rate, but you can get kind of an estimate of what the cap rate was depending on what the sales price was and how many units it is and how nice the park looks. So these are all different ways for you to find out what the cap rate is. So if the cap rate in an area is 7%, for the type of mobile home park that you're looking to buy, then you're hoping that the NOI divided by purchase price of the park you're looking to buy is around 7%. Okay, so let's start with that. So just to recap, the NOI is calculated a year's worth of NOI, and we're dividing that by the purchase price to find out what the cap rate is. So let's take a look here at this example. We have 100 occupied lots. We're only focused on the occupied lots because, again, we're trying to measure future cash flows. So if it's not occupied, it's not generating future cash flows for us. So we're not thinking about this in this initial analysis. Let's say that the average lot rents are $300. So again, we're only looking at the land value for now. We'll deal with the park-owned home section in a different video. The estimated annual income then is 300 times 100 times 12. That's $360,000. We're going to say that the estimated annual expenses is 30%. So 30% of the income coming in is expenses. When we do a more detailed analysis, as you can see, these expenses are actually going to be itemized, and you're looking at them line item by line item. So to get you even more complete picture of what the expenses might look like going forward. But for now, we're just going to use 30%. 30% is on the low end of the spectrum. So typically, you're going to find expense ratio somewhere between 30 and 50%. That doesn't mean that they can't be 75, 80, 90%. I've seen that as well on certain deals. It might not be listed that way, but once you start to dig in, you'll start to see the expenses pile up and a lot of things that were not disclosed up front. They're also a situation where the park is generating negative cash flow. I mean, they're spending more than they're actually getting an income. So in this example, we're going to just stick with 30%. The NOI is $252,000. We are going to say we're going to apply a cap rate of 7%. So, right. So we're just going to guess. Let's just say we did our research. We found out that a 100 space park in this area that's charging $300 lot rents, the cap rate should be about 7%. So our calculated price for this investment is $3.6 million. Let's just say that the asking price is $2 million. This is being offered for a lot less than what we'd be willing to pay for it. So there's actually a $1.6 million in value that we're getting right off the bat. So at least on the surface of this looks like a screaming deal. This cap rate that they're offering this park for at $2 million, if at $252,000 NOI, for $2 million is actually a 12.6% cap rate. So that's a much higher cap rate than what we're looking at. Keep in mind that there's a lot more attention and competition in the space. And so seeing double-digit cap rates is not as common as it might have been in the past. Typically, listed deals are going to trade at between a 5 to 9% cap rate. So that's more in line with what market is. The cap rate can sometimes be a siren song that's bringing you to the rocks to crash upon them, because the cap rate is typically only looking at the price of the park. But what it's not factoring in is your CapEx and your closing costs. So let's say that this park is in dire need of upgrades. Let's just say that it's 15%. So let's say there's $300,000 of upgrades needed. Well, for this particular park, because there's such a spread, I mean, it's still going to be a really fantastic deal. But if you were to pay the $3.6 million, let's say that you were to pay the $3.6 million and the CapEx of $300,000 on top of that, now you're into the park for $3.9 million. And we're looking at an unlevered basis, which means that we're not using any type of financing. There's no seller financing or bank financing for this example. When we go into an actual deal, we have here a section on lending that we could look at as well. But let's just say that that you were paying 3.9 million, then your yield on capital is not the 7% cap rate. So the 7% cap rate might make it sound, because oh, that's the NOI number. That's kind of like the profit I'm going to be looking at. But it's actually going to be closer to a 6.5% because of this additional CapEx that's needed. Let's say that you need an additional 10% in closing costs for whatever reason. Well, now you're down to a 6.1%. So even though the cap rate says, oh, it's a 7 cap, it's a 7 cap at $3.6 million, it's actually a 6.1% yield on capital once you start to factor in these other expenses. So again, when you're doing an analysis of a deal, you need to look at the entire life cycle of it, including the exit price. But for right now, when we're just kind of looking at pricing estimates, and these are sort of shortcuts to kind of give us a sense for value quickly, you could see that even though 3.6 million is a 7 cap on the purchase, on the NOI, once you start to add in all these other different costs, your yield on capital is actually going to go down. So that's just something to keep in mind. To keep things simple, you should probably be focused more on your year one yield on capital. So it's really going to depend on the deal factors, and you're going to have to take a look at the entire 10, 11, this is an 11-year analysis to really understand it. But again, these are just shortcuts to kind of take a look at and generally get a sense for pricing. So this is a good way for you to get a kind of a sense for value. I hope this isn't confusing. If it is, please leave a comment or message on the YouTube channel or LinkedIn or wherever you're seeing this, on my Facebook page, if you want some more explanations or if you have questions. This stuff can get really challenging and confusing. So the best way to really learn it is just to ask a lot of questions. But again, I think that one of the concepts to just keep in mind is just always remember that you're just buying future cash flows. And so if you think of it from that perspective, what's important? It's important that you predict future cash flows, that you predict all the future cash flows, that you know exactly what you're buying, that you're comparing what you're buying to other things that are similar. And that's how you can start to get a sense for whether or not you have a good deal or you don't have a good deal. All right, thank you very much.